DeRosa Insiders. This is Matt Faircloth, and welcome to the Cash Flow Digest. Yet again, guys, this is a program that's dedicated for you listener, generating lots and lots of cash flow out of your portfolio, out of your investment business. Cash flow is king. Cash flow is going to become even more prevalent as we move into a changing marketplace. So this show is all about how you can generate more cash flow for yourself so that you can build up your investment goals. What we're going to hop into now, guys, is something that's interesting. And I think that a lot of folks have talked about this in the multifamily world. The truth of the matter is that there's now real data to back it up. And these are people that are predicting that multifamily was going to see cost surge and starting to see slowdowns and stuff like that. But there's now becoming real data in the multifamily space. This article that came out through our friends at Bloomberg came up with an article showing that apartment buildings there's 6.7 billion with a B. Put your pinky next to your mouth right now, guys. 6.7 billion in multifamily apartment buildings that are viewed to be in distress. Okay, let's talk about what that means and what can be done about it, right? First of all, in distress is like there's over $1 trillion in multifamily debt in the world, right? This is quite a bit of debt. Now, not all that debt is distressed, and 6.7 billion in multifamily debt that is flagged as distressed is what they're saying is that those properties are likely less than what the debt on them are, or the owners are already not able to perform on their mortgage payments, right? Those are two of the criteria for distress. There's also other factors here, such as these are in floating rate debt, and these properties are not going to be able to refinance or convert over to fixed rate debt, such as Fannie Mae, Freddie Mac, HUD, or small bank financing that you might be able to get from multifamily, right? So that's what all this means is the 6.7 billion. And it doesn't sound like a large chunk to the trillion in debt that's out there, but 6.7 billion by any stretch is a ton of money. And it's a ton of assets, a ton of properties. So the average multifamily is priced at, say, 100,000, 200,000 a unit. So that's quite a bit of units that are flagged as in distress through this Bloomberg article, right? Now, what does that mean to you and me as the investor, right? What it means is that, number one, let's not make the same mistakes that these folks made when we buy. If you guys are going to be buying multifamily, or if you have a goal to buy multifamily, as I hope you do, and if you have a goal to buy multifamily, you really need to check out our accelerator program, which is there to help you achieve your multifamily goals. Go to derosagroup.com/accelerator. If you have that goal, then you don't want to make the mistakes that these folks made, because just about all these deals that are listed here in this article are on bridge debt. So I'm not saying don't get on bridge debt. I'm saying that if you're going to acquire an asset, make sure that you're conservative enough, because we at DeRosa Group have bridge debt deals, but they're not in distress because we have plenty of reserves. We went in with conservative underwriting, meaning like we didn't just assume that things would stay the same and cap rates would stay down and that rents would continue to go up by 20% a year and everything like that, right? We went in not assuming the best case scenario. You got to assume maybe 1 inch away from the worst case scenario when you buy a property. So if you're going to do a deal in 2024, go in conservatively and go in for deals that, as the name of the show is, Cash Flow Digest, go in for deals that do this magic thing called cash flowing. A lot of these deals we're talking about here were bought assuming that they would continue to go up in value and the owner could pass them along to the next person like a hot potato and make money through appreciation, not through cash flow, right? Cash flow is king. It's going to be what you want to target for your 2024 goals as having day one. And we teach our students how to do that, to get cash flow the first day when you buy your properties. So that's the lesson number one here for you guys to learn from this article. Lesson number two, that if you're plugged into the right markets, then you're going to be getting the right opportunities that are going to show up your way. This 6.7 billion, I said this before, but I'll just say it again. It's a big number, but it's also a fraction in compared to the amount of multifamily assets that are out there. So guys, this is not blood in the streets. Multifamily is going to get cut in half. The data's not there. Too many multifamily properties are on long-term fixed rate debt or have debt that has low loan to values, like insurance companies that are backing them and things like that, like borrowing money from insurance companies. They're not going to let you borrow at 80% loan to value. So too much multifamily is in a good condition with regards to its debt for there to be blood in the streets. But if you guys want to catch some of the $6.7 million worth of assets, the way you're going to do that is to be plugged into a specific market. So let's say, for example, one of you guys watching chooses, let's say, a fun city I love to say the name of, Albuquerque, New Mexico. Just a fun city to say, isn't it? Albuquerque. Let's say Albuquerque, New Mexico is a market that you've chosen, okay? And you decide you're going to become the industry expert in Albuquerque. You're going to go and get to know every broker. You're going to get to know every property manager. You're going to get to know every owner, the good blocks, the bad blocks, everything there is to know. That, guys, is how you get the off the market whisper that a deal that is in major distress, that's part of the 6.7 billion, is coming on, and it's only going to be out for like a day or two before it goes and gets resold, or before somebody goes and gets their hands on it. The deal of the decade is not going to be on LoopNet. You're not going to catch the deal of the decade by surfing 15, 20, 30 markets across the United States, hoping that a good deal or a good cap rate shows up. Not going to happen, guys. You're going to watch other people get deals if you do it that way. If you want to be the one getting the deals, plug into one. How many? One market. And that's what we teach our students to do. We help them select those markets. And if you want a tool for free for selecting those markets, go to derosagroup.com/market tool to pick the right markets for them to invest in. Okay, guys? That's what we got. That is how you guys are going to take advantage of the $6.7 billion. One more time, take it next to your mouth. $6.7 billion of multifamily assets that are in distress that are going to need to get retraded. They're going to come onto the market. Hey guys, Matt Faircloth here. Thank you for listening again to the Cash Flow Digest. I really appreciate you guys doing that. If you guys want to hear more about what DeRosa Group has to offer, go to DeRosa Group, DeRosagroup.com, derosagroup.com online. You can hear about all the great things that we offer from an educational standpoint and passive investment standpoint on our website. See you there. And if you guys want to join our online community, DeRosa Insiders on Facebook, where you can watch this program get recorded every Friday at noon Eastern, and you can come on as even a guest or ask questions on the show. We hope to see you guys on our online community, DeRosa Insiders. See you there.